All right, good morning, everybody. My name is Ronnie Withaeger. I am a CPA and I am the tax director at Anderson. Sorry for a little bit of a technical difficulty this morning, but anyways, I'm here. I'm excited, really excited to be able to talk about comprehensive tax reform. It's been a crazy kind of 10 days or so. And with all of this kind of change coming so close to New Year's, everybody's kind of scrambling around just to kind of get somewhat of an understanding of what's going on here. And I'm just really grateful that I have an understanding of tax, that I kind of see what our Congress is trying to accomplish. And I'm really grateful just to be able to spread a little bit of knowledge to you guys and just share with you guys all of the ins and outs of this reform. There's hundreds of pages of information, and fortunately, tax preparers all over the country have a year to figure it out. Here at Anderson, we're gonna be a little more assertive and get this figured out sooner rather than later. But I just want to let you know that today, with all of you guys, and there are hundreds of people on this call, and there are going to be probably a million questions, and I understand that. I'm going to do what I can here, but what I'm going to do in just going through this in preparation for this, I really just decided that I'm going to have to do a two-part webinar on this. Today is going to be very informative. You're going to get kind of a satellite view of everything. And then my next webinar is going to be more of the specific strategies and things that we're going to be able to implement. Thank you for everybody that's kind of making all these comments too and kind of telling me where you guys are all at. That's pretty awesome here. Just to see people from all over the place. But again, my agenda for today is I'm going to outline how this affects individual taxes. We're going to go through rates, deductions, credits, other miscellaneous changes that you need to be worried about. I'm also going to outline how it affects business taxes, and we'll go through some 199A, which is a new section. We'll learn a little bit about depreciation, deductions, corporate tax rates. If time allows, we're going to do some Q&A. I'm going to sit here for probably an hour or so and do what I can. And I might hang out a little bit longer afterwards and kind of answer some of your questions through the chat. But definitely, really, hopefully you can kind of hear some of the enthusiasm in my voice. No tax plan is ever going to be perfect. I'm just going to throw that out to you right now. No tax plan will be perfect. This may affect you negatively in some way. It may affect other people positively in some ways. But, you know, as we go through this kind of stuff, I think you're going to see some stuff that you're going to say, oh, darn, that stinks. And then there's going to be other stuff that you're going to say, hey, that's really actually going to help me out. Just before we kind of get into some stuff here, I mean, there are estimates and things like that, and you kind of always got to take some of this stuff with a grain of salt because it normally doesn't play out how they totally estimate all the time. But it's projected that 80% of Americans will save money on their taxes, and so, like I said before, no plan's perfect, but we're definitely trying to move in a direction that's going to help. Moving into the individual taxes. All right, personal tax brackets. Now, I kind of hope everybody at least has an understanding, but we have a graduated tax system. Now, I know a lot of people get held up on tax brackets and rates and that sort of thing. And a lot of times I'll get questions like, hey, I don't want to make a certain amount of money because it's going to put me into a new tax bracket. Well, this kind of table here will kind of explain it. Your first, here's unmarried, so single. The second column is married, and then you've got heads of household, so that's single, and you have dependent children. we kind of changed this tax rates here. I mean, some of the rates are the same, but if you compare them to the prior years, you're going to see a little bit less of a tax rate and a few less brackets. One thing to point out, that top tax bracket that used to be 39.6 is now 37%. But you can see how this kind of works. The 10% bracket is 0 to 95.25. So if you made 95.25, you would pay $953 in tax. So that's 10% of your first 95.25. And then you can see the 95.25 up to 38.7 is taxed at 12%. So there's this graduated rate that kind of we software and we do the calculations so that you'll be able to kind of understand, hey, if I made X, this is the amount of money that I would pay in tax. I'll kind of reiterate that number right there is less of a bracket. We used to have a 10 and 15%. Now we've got a 10 and a 12%. We used to have a 25% rate. Now we have a 24% rate. All right. There used to be a 28% also, and a 33 and a 39 and that sort of thing. But all of these numbers, all of these brackets are expanded out so that the income level is higher and the tax rate is lower. So I'm kind of giving you a little bit of good news before I give you a little bit of somewhat of some bad news, okay? I want to let you know that your rates are much better, okay? The rates have went down. Now, what we kind of will get into after this is going to be kind of some of the negative stuff to some degree, but we'll get into it. Individual taxes continued. I don't know if everybody kind of understands this, and I can't see the looks on your face. A lot of time I teach people live, and so if I say something that you guys don't understand, I can see the confused look on your faces. But here we are over a webcast. I can't tell, but there's something called personal exemptions. So for each member of your family in the past, you were getting a $4,050 deduction. The new law is not going to allow that anymore. They're going to simplify the code and take out all personal exemptions. So if you're high income, you wouldn't have gotten the personal exemption amount anyways. But if you were lower income, then that was a number that would reduce your taxable income. That number is going to be gone now. So in order for that to be gone, there's a takeaway, but there's also a little bit of a give back. The standard deduction, there's standard deduction, there's itemized deductions. What the government's decided to do is just expand the standard deduction. 70% of Americans take a standard deduction right now. All right, so only 30% itemize their deductions. We'll kind of get into itemized deductions in a minute, but the standard deduction has suddenly just about doubled, okay? Definitely doubled, all right? So if you were single before, your first, I'll just say about $6,000, it was not taxable. That number's increased to 12. So that kind of softens the blow a little bit. If you lose your exemption, then your standard deduction's doubled. So that kind of almost, I mean, for some families it's going to even out. Some families it's going to be better. Other people it's going to be much better. And so, you know, there's a give take there. If you have a ton of kids, like a lot of people I know do, then you know, losing the exemption might hurt a little bit. But we'll get into something that's going to benefit it. But if you don't itemize your deductions and you just take a standard deduction, you're going to look and see that you're going to get a bigger deduction here. If you're single, it's $12,000. If you're married, filing joint, it's $24,000. And if you're head of household, it's $18,000. 70% had used the standard deduction. It's estimated that 90% of taxpayers will use the standard deduction going forward. All right. All right, so individual taxes, itemized deductions. I'm going to kind of go through, for the people who itemize their deductions, some stuff in this is is a little bit rough, but we'll kind of run through it. I want to just kind of explain to you what the rules are, what the law is, how this has changed, what it kind of means to you. So we got medical expenses. So the new law reduces the limitation to 7.5% of your AGI. Now, a lot of you guys will use medical expenses and use a medical reimbursement from your C corporations. That's great if you're doing that because you have no limitation. If you're just an individual out there trying to deduct your medical expenses, the old law made it so that you had to get over 10% of your adjusted gross income. I'll put it a different way. If you make $100,000, you would have a 10% or $10,000 phase out. So the only medical expenses that you would be able to deduct is anything that you spent in a year that's over $10,000. Not a lot of people actually end up with that deduction, but they reduced it down to 7.5% of your AGI now. So that may help some people kind of catch that deduction a little bit. Here's the big ticket one. This one is the one that's got news sites, some states. I just heard New York wants to sue the federal government over the tax plan now, but this is the big one right here. State and local taxes, property taxes. What's happening here now is a maximum deduction of $10,000 is the limit. All right. Now, this isn't going to include property taxes for your rental properties or anything like that. This is your personal property taxes, property taxes on your personal residence. And then if you live in a state where you pay state and local taxes, that cap is at $10,000. Now, the $10,000 number obviously comes from somewhere, but this had a lot of people outraged in California, New York, New Jersey, Illinois, because those states themselves charge their residents a large property tax. They charge them a large state tax as well. California's rate is 13.3%. Okay, and so that's kind of significant number. If you make a couple $100,000 a year, you may pay California $20,000 or $30,000 in state taxes. Well, you're not going to be able to deduct the $20,000 or $30,000 anymore. You're only going to be able to deduct $10,000 of it. You may live in a state that has a high property tax. Some states, there's some property taxes I've seen $6,000, $8,000, $10,000, $12,000 just for property taxes alone. That is going to be limited to $10,000. I was actually at the beach. I was at the beach about this past weekend, and there was a plane flying across the beach, and they were upset with this property and state and local tax limitation. I'm sitting there with my wife, and I go, well, we live in Nevada, which has no state tax, and our property taxes are like $2,000 a year. And so I'm like, if you're really actually going to be upset with anybody, you probably should be upset with your state legislator that charges you more than $10,000 a year in property and state and local taxes. I mean, if I lived in one of those states, I would consider writing to my Congress and senators, just because it's one of those things where the federal government has given a deduction to certain states for having high state taxes. And so all of the rest of the people that live all over the country, we all bear the burden of states that have a high tax rate. I think it's fair to put a cap on it. That's just my personal opinion, but that is kind of what's happening right now, is that there is going to be a cap on it. And I know there are some states, and there's some of our clients who are going to be hit pretty hard with that, and I'm definitely going to do what I can to kind of save in other areas and give you guys advice that will help you. Although I do always say the greatest tax planning advice that I ever give to people is to move to a tax-free state. If you can look them up, there's about 10 or 12 of us that are tax-free states for state and local taxes and have a manageable property tax. So anyhow, it's one of those things. That's a tough pill to swallow, and if you're in one of those states, I'm definitely sorry for that. Judy ended up saying in here, hey, I'm gonna move to Nevada. You know what? I tell people all the time, come to Nevada. I mean, outside of that kind of couple mile stretch at the Strip, it's a very normal city just on the outskirts here. So yeah, would love to have anybody who wants to come to Nevada. So all right, somebody said it's too hot here. I kind of agree with the fact that it's too hot. But then Lynn, that's why we go to California. That's why we go to California during the summer and take advantage of some of your guys' nice weather there. So yeah, so anyhow, yeah, you guys are funny here with all your comments. Appreciate all your guys' comments coming in, you know, representing your guys' states and that sort of thing. All right. All right, so mortgage interest. What's happening here is the allowable mortgage indebtedness of your property. If it's over 750,000, then you're only going to be able to deduct the interest on that $750,000 mortgage. If the prior amount was $1 million, so if you have a high mortgage balance, which some people out there definitely do, then what happens is you expense the allowable percentage of it. Okay, you move you end up saying, I'll just give an example. All right, if you have a $2 million under the old law, if you have a $2 million mortgage, you used to be able to, and you pay, let's just say, $80,000 of interest a year. What used to happen is with $1 million, you are allowed to deduct that amount. So 1 million divided by 2 million is 50% of it. So what you would be able to do is deduct $40,000 of your $80,000 of mortgage interest. Hopefully you guys are following me on that. Anybody who enters into new mortgages right now in 2018 and beyond, 750,000 is your new percentage that we're going to base that on. Okay, so if you have a mortgage over 750,000, you're going to get into one. I don't want you to think that you can't. I don't want you to think that you can't deduct any of your interest. You're still going to be able to deduct your interest, and so it's just a percentage of the total amount is what we're going to be able to take. So you know, a lot of media will say, hey, this is something that benefits rich people. Well, this is something that does not benefit rich people if you have a large mortgage. And so there's definitely some things with the state and local property taxes, mortgage interest. There's definitely some stuff there that you can see is a hindrance and will give people less deductions. All right. So hopefully everybody kind of understands what I'm trying to say there. Charitable donations. The deductible limit has increased to 60% of your AGI. So if you make $100,000 a year, in the past, if you went ahead and contributed that whole $100,000 to charity, you would only be able to take $50,000 of deduction. That'd be half, 50% of what you made. We're getting a little more generous with the charitable donations. It increased to 60% of your AGI now. So you know, give away. Those are always a great way to. Those are always a great way to reduce your taxable income. All right. Let's see here. Casualty losses. Casualty losses. That's, you know, when something bad happens, you get theft or property gets damaged and that sort of thing. That's being repealed unless it's in a federal disaster zone. So, you know, if a hurricane comes through, the government can call it a federal disaster zone, and you can get a casualty loss. But if something ended up happening to your property, you can't take a casualty loss anymore. Here's a big one: miscellaneous deductions subject to the 2% floor. All of those are being repealed. All right. So if you had unreimbursed employee expenses, dues and subscriptions, travel for your job, and you don't get reimbursed for all that sort of stuff, then you're not going to be able to take those deductions anymore. That's kind of a that's kind of a big one, okay? Because you know, when it says subject to the 2% floor, if you make $100,000, 2% of that is $2,000. So if your unreimbursed employee expenses are over $2,000, you can take a deduction for it. Those are actually going away now. Union dues are going away now. You're not going to be able to take a deduction for that stuff. So anyhow, just kind of want you guys to kind of see the item. Remember, I told you 90% of people will take a standard deduction now. That's because of all of this. Okay, there'll be some people who still itemize their deductions, and I'll have some idea. If you're somebody out there that's really charitable, I'll have some ideas for you on how to limit that. But we'll kind of get into some more strategic stuff as we kind of develop our understanding together. I want to develop our understanding together and make sure that that we all have an idea of what's happening here. So just to kind of clarify on some of this stuff, if you end up, I want to kind of go back. I kind of want to just kind of make sure that there's an understanding here. You get to take either the standard deduction or an itemized deduction. So let's say you're married filing joint. Your standard deduction would be $24,000. If you ended up giving $10,000 to charity and your mortgage interest was $5,000 and your property taxes were $5,000, that would equal $20,000. You're going to be better off taking the standard deduction. All right, so you're going to get one or the other. So to answer a question that I saw come through, that is not going to then you wouldn't get a deduction per se for your charitable donations. Okay. All right. Let's see, if somebody's kind of confused by one of the things that I talk about, just hang out after the webinar's over, and I will definitely go through and try to help kind of clarify some of that. But I'll shoot you a message through the chat box here to make sure that you understand it. All right, kind of moving on. Let's move on. All right, individual taxes, miscellaneous facts, a child tax credit. This is a good one, okay? And HR 1 is just the bill. It's the name of the bill. So this increases the maximum credit to $2,000. Prior to the new bill, you would only be able to deduct or you get a credit of $1,000. So that's doubled. And to me, that kind of balances out kind of losing that exemption. If you lose an exemption, then but you get an extra $1,000 credit, then you're kind of balanced out there. But the refundable piece, so what refundable means, just so everybody knows, is let's say you owed zero tax, and after all your deductions and that sort of stuff, or you're low income, let's say. Low income, you don't really owe any tax. The refundable piece is $1,400. So both of those numbers have increased, which is something that's going to help everybody. The child tax credit will help everybody. The prior law had a phase out of the child tax credit at $110,000. That number actually moved up to $400,000. So there was and I just know this because I do a lot of taxes for middle-class families. There's a lot of kind of middle-class families who didn't really get to benefit from the child tax credit. And so the current law, when it increases it up to $400,000, there's going to be a significant amount of people who get a child tax credit who haven't gotten one before. So that's a pretty cool element of the code here. Moving expenses. Moving expenses is repealed. That means it goes away unless you're in the military. So the old code section, if you moved for a job and that sort of thing, took your cars and the moving truck and all that sort of stuff, you were able to get a deduction for it. That's going to go away. Here's kind of a big one: alimony. Alimony. The income side and the deduction side for divorces after 2018 you will not report an income or a deduction for it, which I know that's going to affect a lot of people, but kind of a tough blow for somebody who pays alimony. So if that's your situation, that's kind of a tough one. The health insurance penalty. I've been pretty outspoken about this one. If you've come to any of my events, the health insurance penalty is sitting in the other taxes box of your personal tax return. After 2018, there will be no health insurance penalty anymore. So that was at 2.5% of your income if you did not have health insurance. And I know a significant amount of people ended up taking that penalty because they couldn't afford the high cost of the premium. So that's gone away. Estate issues. All right, so much is said about this sort of thing, but I want to let you know that the gifting amount has increased to $15,000, and our lifetime gifting limit increased to $11,200,000. So that ended up doubling. So if you're trying to shrink your estate, you'll consider gifting, but 11.2 million is kind of the new amount there that you're gonna kind of be wondering about as far as that 35% estate tax. So 11.2, or if it's you and a spouse, then it's 22,400,000. So that's increased. IRA recharacterizations beyond if you haven't done it for 2017, or you're not going to do it for 2017, those are going to go away. Just so everybody knows what an IRA recharacterization is. If you ended up rolling money into a Roth account, for example, but then you decided you didn't really want to do that, you want to put the money back because there's a big tax blow or something along those lines, then you were able to kind of put the money back and recharacterize the IRA and not take a big tax hit on it. You're not allowed to do that anymore. So I don't want. Sometimes people use that as a strategy, and I want you to just kind of understand that that's a spot that is going to go away. Now the 529 plans. 529 plans is, typically we think of 529 plans as saving for college, and so what this is allowing now is for $10,000 per year to be used for kindergarten through 12th grade education costs. So I have a feeling that 529 plans are definitely going to be an expanded tool. If you send your kids to private school, we all know private school is very expensive. You may want to start putting money into those 529 plans. There's about 30 states that allow deductions for 529 plan contributions, and so that's kind of an interesting switch there. So it's not just college anymore. You can use them for kindergarten through 12th grade education costs, and that's tuition, books, things like that. Now, what I have a feeling that we're going to see a lot more of now is those gifting opportunities. I think we'll see a lot of gifting opportunities moving into 529 plans, but that's just kind of a personal thought that I think we'll end up seeing. Alternative minimum tax did not go away. I know that was one of the things that was kind of highly talked about, was that alternative minimum tax was going to go away. But just, I won't bore you with all the numbers and all the calculations or anything like that, but the exemption from the alternative minimum tax, that number approximately doubled. And so I think the amount of people who will be in alternative minimum tax is going to decrease significantly. So, you know, I'd be surprised if we see, you'd have to have a very unique situation to fall into alternative minimum tax with the expanded scope that we're kind of looking at now. So, yeah, anyhow, just definitely, you know, some things on the individual side. I'm going to try and pop into some of your guys' questions here. Just to answer one here, the alternative minimum tax, it's a separate calculation for tax, and what it basically does is it adds back some of your deductions that you take to make sure that you're not just kind of milking a deduction system for paying your taxes. So it's a separate calculation that you know, we'll factor in when we prepare the returns. Most people really don't, you know, have to worry about it a ton. But you know, when you're in some high tax states like New York or California, sometimes those state taxes or the property tax add backs are so high that it ends up making people pay alternative minimum tax. So overall, I don't think you're going to see a lot of the alternative minimum tax anymore. Somebody asked if I can explain the IRA recharacterization a little bit more. The IRA recharacterization is simply if you have a traditional IRA, so that's tax deferred money. If you wanted to, say, roll it over into a Roth account, you'd have to pay the tax right now. If you ended up kind of not realizing how much of a sting it was going to be to pay those taxes, you could recharacterize the money and move it back to your traditional IRA. So what's happening is they're not going to give you that option anymore. So what it really does is it makes it important to, you know, have a tax planning consultation to make sure that you understand exactly what the consequence of rolling an IRA into a Roth account would be. Somebody asked on 529 plans, could you use it for homeschool? My understanding is yes. Do we have to claim gifts if we give money gifts to other people? Yes, if you give a gift that's over $15,000, you have to file what's called a gift tax return. You're not most likely going to pay any tax, but you have to let the IRS know that that's what you've done. As far as I know, backdoor Roth conversions are not going away. You'll still be able to work through those. Is 529 plan available to grandparents paying for grandchildren's education? Yes, you just have to gift the $15,000 into their 529. Is the health insurance penalty still in effect for 2018 but repealed in 19? The slide says this is repealed after 2018. Yeah, so you're good question. Thanks for, you know, asking for clarification on that. But what that means is if you don't have health insurance this year for 2018, you're still going to get a penalty. But in 2019 and beyond, you're not going to get any penalties there. All right, so I got a couple of those questions on the healthcare thing. So, will low-income families still be able to receive Medicaid? Yes, that there's no changes to that. What's a tax credit versus a deduction? All right, that's a great question. All right, let me explain that for a second. So, tax credit is let's say you make $100,000 and you owe $15,000 in tax. If you get a child tax credit, for example, and you get $2,000, that $2,000 will reduce the $15,000 that you owe dollar for dollar. So then you'd only owe $13,000. A deduction is, let's say you have $100,000 and you owe $15,000, but you get a deduction for, I'll just use student loan interest, for example. Student loan interest, what the deduction would do is reduce your taxable income from $100,000 to, let's say, $98,000, $2,000 of mortgage interest or of student loan interest. So now your $98,000, you're going to owe like $14,500 in taxes. Okay, so a credit is a dollar for dollar reduction of your tax owed. A deduction is just a reduction of your taxable income. All right. So let's see here. All right, I'm gonna kind of move on a little bit and kind of get into a couple other things here. Yeah, keep your questions kind of pumping through. Do what I can to kind of answer them if it seems like a good spot. I have 2 kids. Can I contribute 2 times 10,000 to the 529? Yeah, you can. So you can do 10,000 to one kid, 10,000 to the other kid. Yep, absolutely. You actually could do more than that. Your husband, if you're married, husband and wife could each give $15,000 to the to each kid. So you can definitely do that. How does the new law affect IRA disbursements? No change to that. All right, so let's see. Somebody's saying that there's no sound coming through. I want to make sure that you guys can hear me. Just somebody post in there and let me know that you guys can hear me. All right. All right. All right, cool. All right, so I think it might be something on your on the one. If you can't hear it, it's something on your end because I just got 100. Yes, I can hear you. Good. Everyone's paying attention. Hopefully, kind of some of this informational stuff is valuable to you guys. I know tax can be confusing. It can be boring. It's hard to understand and that sort of thing. And that is definitely what we're here for. I have no doubt that I'm going to have to teach about the new tax plan all year long. Okay, and we're definitely going to end up. I mean, a lot of you guys know about our events and have come to our events. I would just suggest if you come out to one of our events, and I don't know if I really have to twist anybody's arm to come to Vegas, but if you come out to one of our events, I mean, we spend a weekend talking about this stuff, and so I just kind of want to throw it out there that coming out to one of those is perfect to just kind of get some of that understanding there. Somebody actually just told me that I can make tax exciting, so thank you for saying that. I think you might be lying to me, but no. Anyways, yeah, I want to try to make it as exciting as possible, and I don't really want any of you guys to have to go write. I don't want any of you guys to have to like go read that 500-page law that I spent like till 2 in the morning, like the last 3 nights reading. So anyhow. Just want to kind of let you know that's kind of what I have to say on individual taxes. Did I hit every little thing that's in it? No, but what I did do is I hit all of the stuff that is really important. Okay, so yeah, we're gonna kind of marching on here and kind of get into some business stuff. Okay. All right, business taxes. Very, very interesting what they're doing with business taxes. This administration is doing everything they can to jog through business. They want to make sure that our businesses, small business owners, even large businesses have the availability, the flexibility to expand and to grow and to help people. So we'll definitely kind of see how this all plays out. But we're gonna run through some stuff that's pretty interesting here. All right, I'm gonna start with talking about corporate taxes. Corporate taxes has typically had a graduated rate, just like the individual tax system. I showed you the brackets earlier. The corporate tax rate has been pretty similar to that. All right, the graduated tax rate for a corporation is completely repealed. All right, there is a flat 21% tax on all C corps. All right, don't get confused with S corps. I'm going to get into S corps in a little bit. C corps. All right, 21%. Now, for some of you guys, we from a strategy perspective, we've talked a lot about having a small corporation where you make 50,000 or less and you're taxed at 15%. it sort of stinks for you, okay, because we don't have a 15% rate anymore. We have a 21% that is across the board, whether you make 100,000 or 100 million. It's 21% across the board. All right, in a C corp, that does not flow through to you. This is not a flow through entity. So I don't want you to think of it as a flow through entity. This is the C corp. It files its own tax return. It does not have pretty much anything to do with your personal return. Okay? So that's the 21% there. So that's the new tax rate. All right, the other thing that's pretty cool about the C corporation, and could be a very interesting planning situation for us, could be a pretty interesting planning situation, is that there's no longer a personal service corporation. Now, what a personal service corporation is, I'll just use an architect as an example. In the past, an architect would never really want to be a C corporation because it's a personal service. It's one person that's providing a service. Architects, accountants, a doctor, a lawyer. If you have a personal service like that, a professional service, you never really wanted to be a C corp because they were always taxed at a 35% rate. At this point, there's no longer a special rate for personal service corporations. I'm pretty confident actually that we're probably going to see some doctors, dentists, lawyers who end up deciding to become a C corp instead of an S corp. It's just going to depend on what your situation is. And so, like I said, in the beginning, I'm always going to say this. There's no way for me to give you guys a slide that is just going to say, hey, this is going to work for every single one of you. All right. So if you're a doctor, dentist, or lawyer out there, and I'm saying, hey, you know what, you may end up becoming a C corporation, please don't rush out and go become a C corporation. Okay. Let's run numbers first. And I'm all about running numbers first. Please don't mistake what I'm saying there as something. But what I do want you to do is I want the light bulb to go off and say, hey, is this something that I should consider? All right. And a lot of you guys are asking about, hey, will this flow through to us? This is not a flow through entity. Not a flow through entity right here. Okay. So personal service corporation, C corporation, this is its own tax return, files itself and with no regard to the individual rates. The deadlines can be different throughout the year, just depends when you set the thing up. But again, 21% tax rate. Just another thing that I will say is there's been a lot in the past that has been said about there's been a lot that's been said about overseas income, and a lot of our corporations in America have taken their headquarters overseas and have a lot of foreign profits. They instituted a 15.5% repatriation of foreign profits, and are going to let corporations bring money back to America at a smaller rate. So not that might not affect a lot of us, but just an interesting add in there is that there's a tougher stance against foreign profits, and it's more about just, hey, just do it here. Now there's a more fair tax rate of 21% instead of a highest rate of 35% on the corporation. All right, so net operating loss. And net operating loss is when you have a loss in your company. What you typically have been allowed to do is carry the loss back to prior years, and you've been able to go back 2 years, and then you've been able to go forward 20 years. So a lot of times when somebody has a loss in their C corporation, they'll just let the loss kind of carry forward and offset its future profits. On the individual side, kind of same thing. Although there has been some rules where, you know, if I made $1 million last year and then I lost $1 million this year, there have been situations where you've been able to carry your loss back to a prior year. So what the law is going to change is that ability to carry back. You're not going to be able to carry back on losses anymore. However, you are going to be able to carry forward, and there's going to be no limit on how long you carry forward your losses. All right, so a little give take there. We took away the carry back, but we added years to carry forward. So yeah, we'll see what happens on that, but a change there that I want you guys to know about. The other big change is that the allowable deduction for an NOL is 80% of your taxable income. Let me give you an example. So let's say you had $100,000 of income this year, but last year you ended up having a $200,000 loss. So you had this net operating loss for $200,000 that you were carrying forward. What's going to happen is you're only going to be able to take an 80% of your net income deduction. So on the 100,000, 80% of that is 80 grand. You'd be able to use 80 grand of your $200,000 loss from a prior year, and you'd be left over with taxable income of 20 grand. All right, so that's kind of one that's a change because it kind of sticks you a little bit. You'll still get all your carry forwards and that sort of stuff, but you just kind of want you to understand that there is going to be a limitation on that now. Now, here's a great one: depreciation. Section 168. This is bonus depreciation, allows 100% deduction through 2022. Then it's going to gradually kind of reduce, but that's huge. That's huge. Bonus depreciation, if you go out and you're buying equipment for your business and that sort of thing, 100% deductible. And there's not a limitation to that anymore. It used to be that you couldn't do bonus depreciation if it wasn't new property. If you buy a used truck for your business, you can still bonus depreciate it for 100%. So that's over the next 4 years, is you're going to be able to do that. Section 179, which that was the method where we did 100% deductions. 100% deductions in the past was because of Section 179. There were all these rules to it about having to have income and that sort of thing. But Section 179 is still there. I mean, we were kind of joking about it with another accountant earlier. If bonus depreciation is 100%, then there's really no reason you would need Section 179 anymore. But depreciation has expanded, much more liberal with depreciation and what deductions you're going to be able to take now. Right? Somebody asked, what's the difference between 168 and 179? Right now, there's not much of a difference. Not really sure. Maybe they just didn't want to scrap 179 completely because bonus eventually is going to go back to down to 80, 60, and then 50%. But so they want to scrap 179. But for the next 4 years, it's going to be one and the same. Will Section 178 be applicable to pass-through LLCs? Absolutely. So, I put it under corps. I mean, right now I'm kind of talking just general expense with depreciation. No matter what kind of entity you have, you're going to be able to do that. I am going to research a little bit more thoroughly into depreciation as it pertains to real estate. So some of you guys are kind of asking about some of the issues with real estate. That's probably going to be another webcast that I do, but I will say that from early indications on things that I've seen, we're gonna like what we're gonna see with things like AC units and roofs and things like that when it comes to depreciation. But let me kind of dig into some of those rules a little bit more, and I'll teach a little bit more on kind of the real estate piece of that as we kind of dive into a little bit more. Luxury auto limits. A lot of people ask me about buying nice cars and what that means. In the past, luxury auto limits have been the government doesn't want to give you a big, huge deduction for buying a Ferrari or a really nice car. So in the past, I mean, you've been able to take small deductions like four to 8 grand a year. Those amounts have increased. Year one's 10,000 now, which it still doesn't cover the cost of the car, but there has been an increase in that. I just kind of want you guys to know that. Entertainment. This is one that you guys are not going to like, and I'm not really sure why they kind of took this out, but entertain. I mean, there's always been this meals and entertainment. You guys are kind of probably pretty familiar with meals and entertainment. And so, you know, what's happening now is meals are still going to be deductible. If you go do a business meal, it's still going to be a 50% deduction. No problem with that. However, entertainment, amusement, and recreation, that stuff is non-deductible now. And so I understand that's a little bit of a hit for people, especially if you're in a business where, you know, maybe you take somebody out to a ball game or something along those lines. Those are not going to be, you're not going to be able to take a deduction for that anymore. So maybe I'm going to kind of dig into it. People might get a little more creative with this, just so you know. Just so you know, I mean, people may end up getting a little more creative in where they code this stuff, but yeah, I'm not going to make any suggestions on that just yet. But you know, somebody jokingly just said entertainment. Maybe the IRS spent too much time auditing this. You know what? I'm gonna be honest with you. It looks like a lot of the stuff that they scratched and took away, it is definitely stuff that they spend time auditing on. And you know, so that's an interesting theory that you kind of threw out there, and Andrew, that crossed my mind as well. Just so you know, is yeah, and it almost actually, in talking to some of our other CPAs here, you know, we're almost to some degree a little bit happy on some of the things that they took out, just because it was like, wow, you know, that might be an audit that we don't have to deal with. But anyhow, good theory on that. That could definitely that could be true there. Does this include business trips? Somebody asked. That's different. That's going to be travel. Okay. Good question, Dee. That's going to be travel. So don't worry about that necessarily. But I will say this: if you are traveling, and then, you know, let's say you come to Las Vegas and you want to take your CPA to a magic show or something like that, then that's not necessary. You're not going to be able to deduct that. All right. Country club expenses, golf tournaments, that stuff's that's fallen into the entertainment stuff. If you're an S corp, same type of rules on this. If you do a fruit basket, maybe a fruit basket is not entertainment. Okay, that's going to be, you know, potentially promotional or advertisement type stuff, and that sort of thing. So don't think fruit baskets. Think more baseball, football games. You know, going out to a club and having a good time. Think more like that sort of stuff as far as entertainment stuff goes. All right, let's see. All right, let's see. No more Golf Masters tournament. Yeah, maybe that. Yeah, that's one that's gonna get you a little bit. I'm kind of trying to skim through a couple of your questions. Somebody said, does that include a corporate retreat? A corporate retreat, your airfare is going to be travel, your hotel is going to be travel. You know, what you do as far as, like, you know, fun goes throughout the day, yeah, it's probably going to affect that piece of it. But you know, I haven't seen any threats to legitimately. None of that's going to change. Somebody asked, what are the salespeople going to do now? Yeah, they're probably going to do the same thing. They're just not going to get a tax deduction for it anymore. If you give gift cards as a thank you, a gift is different than entertainment. All right. So think a little bit different on that. A gift card, if you're doing a $25 gift card, something like that, you're going to be able to deduct that under gift expense. Let's see. So all right, let's see here. Some of you guys' questions are still popping through. A lot of this stuff too, guys, just so you know, with the law changing and that sort of thing, it's going to kind of create a whole new spin on what people decide to take and how they interpret the law, and then people may end up getting audited on stuff, and there's going to be some precedent there. So it's one of those things that we're going to continue to look at and continue to get an understanding of. All right. Let's see. So, can you gift a golf day? That's a good question. The rule on gifts, just so everybody is aware, is you're allowed to gift somebody a $25 gift. That's what the IRS allows as a deduction. Anything that exceeds $25 is typically supposed to be non-deductible. So if you got a cheap golf course, then something like that could be fine, and you throw that under gift. So you're trying to, I see you getting creative there, and I like that. But and I want people to do that. I mean, if you think creatively and you kind of want to kind of run something by me, I'm always happy to kind of talk about this stuff. All right. Let's see. All right. Here's the big one. This is awesome. Okay. And there's going to be a lot more conversation on this. Especially as I do a strategy webinar, and I'll just put it out there. I'll do a strategy webinar again next Thursday. I'll do it at the same time. I know some of you guys were asking when that's going to be, and I'll do the strategy webinar at the same time next week. And but this is going to be one that we really kind of talk about quite a bit, and just develop our understanding on it. All right, in the new section 199A, all right, section 199A, this is kind of, this is going to be something that, oh, I'm sorry, I skipped the business interest. I'll go back to that in just a minute. 199A, if you have a pass-through entity, this is a partnership, an S-corp. If you have disregarded entities, like for an LLC for a rental property, if you have sole proprietorships where you file on Schedule C, all right, these are all entities that don't pay their own taxes. They pay taxes on your individual tax return. That's why we call it a pass-through or a flow-through. Whatever income you have on any of those types of things flows to your individual tax return. So this is when I kind of said this administration is kind of big on booming business and running through business. If you have qualified business income through a flow-through entity, you're going to get a 20% deduction from that gross income that's generated from that. Let's say I have an accounting practice that makes $200,000 a year, and I have an S-corp. I pay myself a salary of $50,000. I have $150,000 left over that's going to flow through to my personal return. There is going to be a form that's going to generate a 20%. It's a free 20% deduction. So as soon as all you guys kind of start complaining to me about how entertainment's gone, how you can't deduct your interest, and different things like that, I'm going to say, yeah, but the IRS is giving us a free 20% deduction on our business income. Now, there are limitations to this, okay? And I'm going to get into some stuff, but if you make under $157,500 from your businesses, if you're single, double that if you're married, $315,000. Whatever qualified business income you have is going to get a 20% deduction. Now, if you are a personal service type corporation, or S corporation, partnership, disregarded entity. If you're a doctor, dentist, lawyer, accountant, if you're in professional services like that, and you're married, you're over $315,000, then you're not going to be able to get the deduction. Okay, it's a small business. It's small business. Okay, professional services. Okay, professional services over 315,000 are going to have an issue with this. Any other business, real estate, if you're in retail, all of those types of businesses, you could make $2 million and you're going to get a 20% deduction off of it. All right. So kind of sticks to people who are, if you're in sales, if you're a sales rep, 20, I don't think that's not included in it. It's more professional service, doctors, dentists, lawyers, financial advisors, stuff like that. All right. So it's net income. Okay. If it's rental income, there's no cap. Okay. If you're investing, here's what I want you to understand is that if it's short-term, long-term capital gains, dividends, interest, annuity income, stuff like that, not going to be included in the 20%. It's more small business, not kind of investing type stuff. So if you have capital gains and that sort of thing, we're not going down that. All right. So interesting though, right? I mean, I don't know if anybody's heard about this, but think about it. If you're a business owner and you think, I want you to kind of break out professional services. Like I just said, if you're over 315,000 and you're in professional services, you're out of luck. However, if you're in any other type of business, all right, retail is going to be huge by that, will be affected huge by this. If you're fast food, restaurants, that sort of stuff, 20% deduction. Okay, and that's good. Real estate flips are not. Real estate flipping is ordinary income. If you're a flipper and you're doing a lot of flips, you're taking ordinary income. Now, if you have a rental for 10 years and then you sell it, that is a capital gain. All right. So if you're real estate investing, don't be confused by that. Real estate investing is ordinary income. So it's going to be good for real estate investors. It'll be good for real estate investors. This is always going to be where we want to run your numbers though. Okay. Like I said with C corporations, I don't want you to just say, oh, I need the 20% deduction on my flipping, so I'm going to go get an S corp now. All right, because if you make $1 million from your W-2 job, you're going to be in the 37% tax bracket. And you know what? It may be better for you to flip through a C corp and take the 21%. All right, it just depends on your numbers. All right. All right, so 199A, it works with rental income. it's a 157 700 is going to be your single limitation. Excuse me, 157 500 is the limitation if you're single, and double it if you're married. So anyhow, I hope everybody's going to kind of catch this. This is going to be the bulk of my strategy talk. When I go through and talk strategy with you guys next week, this is going to be a big chunk of what I talk about. I want you guys to understand that there's going to be a nice opportunity for us on some of this. What I also want you guys to know is Anderson's been teaching a certain approach for a long time. And this is going to change some of the way we look at things. And so I want to really just kind of emphasize that consulting with us is going to be really important on some of this stuff. But you guys are firing questions away, and I'm going to do everything I can to answer these questions. But Just so you know, there's hundreds of people who are pushing questions through, and I'm going to do everything I can to kind of get through those. We will, oh yeah, you know what? Let me get back to business interest. Thank you for the reminder on that. All right, business interest. If you have a company credit card and you're getting interest on it, you're going to be able to deduct the interest, but it can be limited. The limitation on business interest is the sum of interest income you have in your business plus 30% of your taxable business income. So if your corporation makes $100,000 and you're showing let's just say you had interest expense of $50,000. If you have that $50,000, you're only going to be able to deduct 30,000 of the 50,000. Okay, because that's 30% of your 100K. Now, if you had interest income too, then that would be added to it. But business interest can be limited, but it also can be carried forward. So in that example, if you had 50,000 of interest expense, you'd be able to deduct 30,000 of it. 20,000 of it would carry forward. Okay. All right. So hopefully that kind of makes sense. So there are some major changes, guys. Very, very interesting here, like just what we have. There's so much information that's out there right now. I probably ended up kind of blowing your guys' minds a little bit with some of this information, because I know my mind has been, just thinking about it, considering all the facts and that sort of thing this entire time. I've been thinking about it a lot, and there just is a lot of different things out there. Me, Toby, Clint, Jeff Webb, our department, we're all getting together. We're going to have Michael Bowman, we're going to have meetings on this. We have our staff researching all the different ins and outs of these types of things, and we're definitely going to be, really, really proactive about it. All right. Here's what I'm going to do. I have on here a slide that shows our tax planning packages, and I really just want to emphasize that working with us in this time is just very, very important and valuable. This is our normal pricing on our packages. Some of you guys already have tax packages, and what I want to do is I want to do I want to run a kind of special for you guys that kind of adds to some of the value that we can provide. I'm just humbled by the hundreds of people who have been on here. What I'm going to do, and everybody knows about this, but the main caveat of this is our units of time. If you look at the units of time in each of the packages, that's kind of the hours that we spend working with you guys on anything tax, accounting, bookkeeping, consulting, any of that sort of stuff. If you end up letting us know that you came to this event, on the investor package, we'll add 50 units. On the professional planning package, I'm going to add 80 units. And on the executive package, I'm going to add 200 units of time. Now, just I think it's a great ad. And just so you know, I definitely think that within our packages, you get a bang for your buck, and the advice and what we can kind of consult with you on, it will give you strategies that saves you the money. But anyhow, I want to throw that special out there for you guys. So that's kind of one thing that we're going to do, and you can see what we have within each of our packages. I'm gonna have Desiree, who's on our call, but I'm gonna have her send you guys a link to this to this page, so that if you want to sign up for them, you can, and make sure that you get those bonus units. But she'll be able to send everybody a link, or I can do it. So hopefully you guys end up seeing that Anderson spot where you have that link to do it. That's the tax offer that I want to give you. The next thing that I want to give you is a tax-wise workshop. For anybody that has attended a TaxWise workshop before, you know what we do. We do a 2-day class. Toby does day 1. I do day 2, and we go through all the ins and outs of this. Normally, the price is $19.95 to attend. If you end up signing up for the class, I mean, this is blowing it away, but it's $97 to come to it. You just got to use the coupon code TAXPLAN. And here's the website right here for you to go and register for that class. Like I said earlier, I don't know if I have to twist anybody's arm to come out to Vegas and have a good time. Although with entertainment costs not being deductible anymore, maybe you guys won't want to come out and see us so much, but your travel and your lodging will still be. But would love to have you come to a TaxWise workshop. We go through about 40 or 50 strategies that you can implement that'll save you on the tax side. And just, want to just say, I mean, I'm just grateful. There's, like I said, I mean, there was over 800 people on this live. I want to say thank you. I'd also love for you guys to add me on LinkedIn. A lot of times I end up going in there and posting tax updates. If you already have a tax package already, I'll still give you an event bonus if you want to re-up your units of time. I know a lot of you guys probably have it, but yeah, take a look for me on LinkedIn though. I definitely love the social media side of things and love kind of putting tidbits out there for you guys to learn from. I will sign us up and do another webinar next week. The focus next week will be more on strategy, and would love to have you guys sign up again. Thank you so much for your time. I'm going to sit around and I'm going to do what I can to answer some of these questions, and we'll go again. I'll leave this up here so that you guys can see the coupon code for the TaxWise event. Thank you guys so much. Really, really appreciate you guys. I hope you found this helpful. If you have advice that you want to put into my queue here on how this webinar could have been better, definitely shoot that out there. There will be a recorded version of this webinar that's on our Platinum website. So if you're a Platinum member, you'll be able to log in and see that. But and if you need to become a Platinum member, that's really easy for any of us to accommodate. It's a great deal, opportunity, and that sort of thing. So anyhow, put any advice or feedback, anything you want me to know. If you loved it, you hated it. I know some of you guys were telling me move on to the next thing. I'll take all the advice you guys have, try and make these things as educational and valuable as possible for you guys. But again, love you, appreciate you. Thanks so much for being with me today. And next time when we come, I'll try to have my media all set up so you guys don't hear me moving around and getting mad at people for it not being set up right. All right. Thanks, guys, so much. Appreciate you. All right. Bye-bye.